Hello everyone and welcome to the concept revision for Ind AS 115. This is a very important standard and I would say it's an examiner as well as interviewer's favorite. In almost every accounts, finance and audit interview, you will in all likelihood be tested for Ind AS 115, and so is the case with almost every exam questions. Since it was introduced in 2018-19, it is the second youngest standard after Ind AS 116. Since 1819 all the way up to 2022, it has been tested in every exam, an average weightage of around 10 to 12 marks. So this is something which is very important. Now, why is Ind AS 115 there and what is the problem in the older standards? Like before this standard, you had two standards, one very similar to AS 7 and AS 9, one for construction contracts, one for regular revenue. The standard says now we don't need any two standards, we will bring everything under one roof and we'll have a common principles. So there were two core principles which sit at the base of Ind AS 115. What are those principles? First, you should recognize revenue as and when performance obligations are discharged. Second, at a price which an entity reasonably expects to receive for the performance obligation. So these are the two core principles. And why do we need these principles to be separately applied? Because in case of contracts, it may not necessarily be the case that whatever is mentioned in the contract is the revenue that you are receiving for that performance obligation. Like for example, you are an AC company like Voltas, and Voltas is selling air conditioners. Along with that, it is giving you a 1 year free, apparently free service and a 2 year apparently free warranty. So when we look at the total consideration, Voltas says for everything together you have to pay me 20,000 rupees. It does not give you any bifurcation. It says, well, servicing is free for the first year, warranty is free for the first 2 years, and as a result one can say that, well, almost everything is attributable to the AC, and hence if you are in the books of Voltas under the older standards, you might have said that you will recognize the revenue, bank account debit 20,000 to sales 20,000, and hence you will recognize the entire revenue in the year when the AC is sold. However, in the subsequent years, when servicing happens, you are actually incurring servicing cost. No separate revenue recognized. Warranty, you are actually repairing the AC if the need be. No separate income for warranty. And as a result, this is where the problem arises. You are not recognizing revenue as and when you are doing the work. Yes, you are selling the AC. That is just one part of the promise. The other part of the promise involves giving service. The other part of the promise also involves giving a promise to repair. And as a result, you should ideally recognize revenue as and when these promises are discharged at an amount that an entity expects to receive. Now, the entity expects to receive free, incorrect. The entity expects to receive some consideration. If it genuinely expects it free, it will be free on a standalone basis. So if I remove the AC, if I remove the warranty, and if I just tell Voltas ek kaam karo, AC hai mere paas, warranty bhi hai mere paas, tu mere ko free mein service dete jao. Voltas is not going to do that, because on a standalone basis it does not give it free. Well, if it does not give it free on a standalone basis, it does not even give it free as a part of this packet. It may be showing it as free to you, but it is not free. And hence we will have to figure out how much is a consideration allocable to service, how much is allocable to warranty, and how much is allocable to the product, and accordingly recognize the revenue. For this, Ind AS 115 has a 5-step revenue recognition framework. In the first step, it says you identify the accounting contract, the features of an accounting contract. In the second step, once the first step is met, only then will you go to the second step, where you look at the contract and figure out whatever are the promises in the contract, the performance obligations. Once you identify that, in the third step, you figure out whatever is the transaction price, the total amount that is expected to be received under this transaction. And in the fourth step, it is a combination of step 2 and 3. Once you know the total transaction price, for example 20,000, and the total performance obligations, the 3 performance obligation, you will allocate transaction price to the performance obligations. In which ratio? Well, typically in the ratio of the standalone prices, but we will study that. Now, once you find the 3 numbers attributable, now you go to the last step, which involves recognition of revenue. When will revenue be recognized? Well, when the performance obligations are discharged, when the control of the goods and services are transferred, that is when the revenue is to be recorded. So over here, you will look at when is the control of the AC transferred, when are the services rendered, when is the warranty service rendered, that is when the revenue recognition will happen at the 5-step revenue recognition framework. So what are we going to study? We are going to study all the steps. From an exam standpoint, in my opinion, step 3, 4, 5 being the most important steps. But nevertheless, we'll study step number 1. What is step number 1? Identifying the accounting contract. In case of an accounting contract, there has to be an agreement between the parties on what are the promised goods or services. There has to be a clear agreement that which are the goods or services which have to be rendered. It cannot be ambiguous. What is the consideration that is going to come? So ऐसा नहीं कि चलो देखेंगे जो मनाता है वो आप पे कर दो, नहीं. Consideration may be variable. It may be linked to certain bonus, may be linked to performance, but those parameters have to be clearly identified. So your consideration has to be identified. The goods and services that have to be transferred have to be identified. The transaction has to have commercial substance. You are not just two parties who are engaging in exchanging almost similar goods and services. No, that will not work. The transaction should have commercial substance, and the most important thing on which cases can come on this section is it should be probable that the consideration should be received. If so, you will say, sir, that is obvious. Well, not necessarily. If you are rendering some goods and services and you believe that paisa nahi aayega, then there is no point recognizing revenue in the first place. If you believe that the benefits are not going to be received, sir, tum render hi kyun kar rahe? Maybe koi gangster hai samne. Maybe you want to develop your track record. You want to enter into a new market. We don't know the reason. However, if you believe that the consideration is largely not going to be received, you are going to get maybe 5-10% token money. You are not going to recognize revenue. At least now. So then we will never recognize the revenue. No, you will recognize at a later date, but not immediately. If you believe that the consideration is not going to be received. For example, if let us say you are a builder and there is a flat buyer who comes and it's a very exclusive high-end flat, you have seen as per your past records, a lot of people try to give token money, but then they believe that the loans will be sanctioned, loans are not, and hence the token money gets forfeited. You don't believe till the time money is received that the consideration will be received. So in such a case, you will postpone revenue recognition till the time either consideration is received at a later date when there is a full accounting contract, or the standard as a special case that if the contract is terminated and there is no future promise or performance obligation, like after 3 months, if the party is unable to pay the money, then you don't refund the token money, in which case the contract gets terminated and you have no further promise, in which case after 3 months you can recognize revenue, maybe other income for that token money that is received. Okay, so this is about the accounting contract. Remember, you can go to step 2, 3, 4 and 5 only if step number 1 is met. So for example, if you have entered into a transaction which is lacking commercial substance, then you will not even go to step 2, step 3, step 4. The standard says if there is no accounting contract for the purpose of Ind AS 115, you don't even need to go ahead. If money is expected not to be collected, if the transaction is 100 and you believe 95 will be collected, it is substantially large amount to be collected. You can go ahead with step 2. However, if 5 is expected to be collected and 95 not expected to be collected, then there is no point starting the revenue recognition process in the first place. So these are the important features that have been discussed over here in case of an accounting contract. In certain cases, if the contract gets terminated, then the consideration that is received, which you don't have to refund, then at the time of termination, you can recognize this as a revenue. A few ancillary concepts are also discussed over here. That is, can I combine various contracts which are entered at the same time with the same party? The answer is generally no. You will record revenue under each of the contracts separately. So for example, you have received 5 projects to construct dams across the state of Himachal Pradesh, then the revenue on each of those dams will be recorded separately as per their respective stage of completion. However, if these 5 dams were negotiated as a single package subjected to a single overall profit margin, that is all or nothing contracts, in which case you can combine and treat them as one, but in other cases you will have to show them separately. Again, sometimes a question might ask you to calculate contract revenue or contract units or contract tenure. This is the number of units or tenures where you have enforceable rights. Like you might take a gym membership for 12 months where they might tell you that 3 months is non-cancelable, the remaining 9 months can be cancelled if without any penalty if you want. In which case you have enforceable rights. If you are a gym, you have enforceable rights on the customer only for 3 months. Your contract tenure is just 3 months in such case. to start with. These are just ancillary concepts. Okay, so that is about your step 1. I would not really put a lot of weight behind step 1. Step number 2 is identifying performance obligation. This is largely a theory step. It does not really come directly in the exam. Has a fair degree of ambiguity involved as well. So what do you mean by performance obligations? Performance obligations essentially means promise. Like, I have a promise to deliver AC. I have a promise to give service. I have a promise to give warranty. So your performance obligation or PO over here essentially refers to promise. So how many performance obligations are there? Well, depending on how many promises are there. Well, the standard says that you will record performance obligations separately if these promises are what you call as distinct. When is it distinct? Where each promise gives a separate benefit. So there is separate benefit which is received now. Typically we do assume that for every promise you are going to get some benefit. So each promise results in a separate benefit which is separately identifiable. Acha, when is it separately identifiable? Well, it is separately identifiable if it is not a part, it's a negative definition, if it is not a part of a significant integration exercise. Significant integration exercise means if you have to construct a power plant, constructing that power plant, so let us say you are a contractor who has to construct a power plant, there are a lot of responsibilities to ensure the piping is done properly, the wiring, the electrical fittings, the installation, the drainage, sewage, everything. All of these are promises, but all of these come together as a part of a single integration exercise of assembling the power plant. So over here, this is not a part of a significant integration activity, because if it is a part of significant integration activities, there may be 500 different promises, but all of these are linked to one single promise of constructing the power plant. Like if you assemble a PC, you might say that I want Intel i7 processor, I want an Asus motherboard, I want let us say a Dell monitor, a Dell keyboard, you might have XTB. All of this is a part of a single integration exercise, and hence there's a single promise to assemble the PC. We don't treat it as 500 different promises. Otherwise, to find the stage of completion for each of those 500 promises is extremely difficult and not viable. Or second, it is not resulting in a significant customization. Again, significant hai ya nahi wo dekhna padega. Significant customization or modification. So if there's a significant customization or modification, then the product and the customization exercise are treated to be one and the same. So if you are taking a software which involves significant customization, then you are buying what is called as a customized software, in which case they are not separate promises. And lastly, they are not highly interrelated. Now, whether they are highly interrelated or not is fact-based. The question is to tell you that they are highly interrelated. They are not highly interrelated. If all of these are not satisfied, that is when we say that the performance obligations or promises are distinct, and if they are distinct, that is when you record them as separate performance obligations. So there may be 20 responsibilities as a part of you having to construct a metro or a power plant. Those 20 are a part of a single integration exercise, and hence there's a single promise, not 20 different promises. Second, you might be customizing, like a lot of developers like TCS, Infosys, they are into a business of customizing SAP softwares for their clients, in which case you're doing a significant degree of customization, in which case you have a single responsibility to give a customized software. Third, there may be activities which are highly interrelated, which means let us say you're designing a mall, and the mall construction is dependent on design. Design can keep on changing, so construction will also keep on changing. They're highly interrelated, in which case they will be treated as a single promise. However, AC and service may have some relation but not highly interrelated. They're not a part of a significant integration activity, not highly customization or modification. Same is the case with warranty, in which case they can be treated as 3 different promises. So over here you have to very clearly figure out whether all of these conditions should not be satisfied. I mean, as in it should not be a significant integration, it should not be significant customization, not be highly interrelated, in which case they are separately identifiable, in which case there will be different promises. And if they are different promises, then they are different performance obligations. So this is about a single promise which is distinct. However, it might happen that your agreement has a series of similar promises, like you have taken an annual subscription of newspapers, in which case there are 365 promises that the newspaper company has to deliver 365 distinct newspapers to you. Now one can say, यार वो तो newspaper का single है, नहीं कैसे single है? Is newspaper of day 2 a part of a significant integration exercise with day 1? No. Is newspaper of day 2 customizing newspaper of day 1? No. Are they highly interrelated? No. In which case newspaper of day 2 is distinct from newspaper of day 1, and you have 365 different promises. However, because these promises are largely similar to each other, it is considered to be a series of performance obligation which is considered to be distinct. So over here, significant integrations, these 3 points are mentioned, and we have said that for a series of performance obligations that are substantially the same, it is treated as a single promise for the purpose of convenience. It is treated as a single performance obligation. Okay, there are a lot of cases linked to this. From an exam standpoint, you don't directly get cases only on this, you have some numericals involved as well, but you need to understand what they mean. Next is a few special cases involving principal and agent, like there can be a consignor and consignee. If I just give goods to my consignee, I do not recognize the sale because control is not transferred. Agent acts on behalf of the principal, and hence revenue will be recognized when the consignment agent ultimately sells it to an outsider. Again, if I am recording revenue in the books of the principal, the entire gross revenue will be recognized, but in the books of agent only the net amount, that is net of the commission, should be recorded. When is a particular entity treated to be an agent? When it is working on behalf of someone else. When is an entity a principal? If it is primarily responsible for discharging the performance obligation, in which case it is a principal. Like Book My Show might be responsible for the ticketing business. Now Book My Show is not going to go and play a match. However, if Book My Show has the ticketing rights, in which case it is primarily responsible for managing the event and distributing the tickets. It may not necessarily be performing the song in a concert, however it is primarily responsible for giving the tickets, in which case it acts as a principal, in which case gross revenue is to be recognized. You have to look at the facts of the case very clearly, see who is primarily responsible. If you are primarily responsible, not acting on behalf of someone else, then you can be acting as a principal and not an agent, in which case you can recognize gross revenue. Generally agents do have inventory risk, and they do principals do have inventory risk, and they are also responsible for a pricing discretion. They can set up prices in a manner that they want. Okay, so this is principal versus agent. Certain cases you have upfront and non-refundable fees, where you might, let us say, take a telecom connection and you might be charged some activation charge. Now against that activation charge, are you rendering any service? If the answer is no, then this is not a separate promise. However, it is a consideration received which is a facilitator for the other promises. So that activation charge will be recognized as an income as and when the remaining voice and data income is recorded by, let us say, the telecom provider like Airtel. On the other hand, if you are joining, let's say, a gym, and you have been told that at the time of joining you will be charged 500 rupees and you will be given a welcome kit. So there is a promise against which you are paying that 500, in which case there is a performance obligation, a promise to deliver the welcome kit. So over here, if an entity is under an obligation to deliver goods or services like welcome kit, then it is to be recorded against a separate performance obligation. However, if the entity is going to transfer goods and services at a future date like international roaming, then over here this is to be recorded immediately, whereas this is to be recorded as and when the future goods and services are to be provided. Okay, so there are various cases over here you can refer for performance obligation, but all of them are theory based. Next, going to the more important parts of the standard, that is step number 3, which involves transaction price. What is transaction price? It is a price an entity expects to receive. consideration that an entity expects to receive, which excludes consideration that the entity collects on behalf of third parties. Like I might sell goods at 100 and also levy an 18% output GST. I collect 118 from you. What will be my revenue? Well, it will be 100 only, because 18 I am collecting on behalf of the government will not be a part of my revenue. But what about variable consideration? So this is fixed consideration. Fixed 100 rupees I'm going to receive, that will definitely be a part of my transaction price. But what about variable consideration? The standard says that the variable consideration should be a part of transaction price if it is not constrained. Now the language in the standard is fairly complex, but the simple interpretation of this would be that if you expect that the consideration will be received and it is unlikely that you are recording the revenue now and the reversal is going to happen, then the standard, in the language of the standard, says it is not constrained. Simply put in, if you are confident enough that the variable consideration is going to be received, it is not constrained. But if you are dilly-dicey, you are not very sure whether the variable consideration will actually be received or not, in which case the standard over here believes that it is constrained. If the variable consideration is constrained, it should not be a part of transaction price, at least for the time being. If it is not constrained, that is free. Constraint means restriction. If the variable consideration is not constrained, that is, it is free, in which case you can take it as a part of transaction price. However, if it is restricted, it is constrained, then it should not be a part of your transaction price. Sir, what are the examples of constraints? For example, you may be a freshly qualified engineer, you don't have any track record, you get a contract to construct a bridge. You say, हम कर देंगे 3 साल में. There's a bonus that you're going to get if you construct the bridge within 3 years. We say we'll complete it in 3 years, but you have no track record to back that. As a result, there is constraint, there's restrictions. We would say no, performance bonus is variable. We don't have enough track record to believe that the consideration will actually be received. It may be that you will recognize the revenue based on stage of completion, and then ultimately you might have to reverse it if the consideration will not be received. On the other hand, if you are an established infrastructure company with 50 years of experience and you have completed almost all of such similar contracts in 2 years, then you believe that it is not constrained because you have a track record to prove that. Or maybe the performance bonus is linked to factors which are beyond your control. For example, if you outperform the Sensex over 5 years, that is when you will get bonus. But Sensex is not in my control. I can see how well I will invest, but how Sensex will perform is not in my control. It is constrained. Or if the period of time is very long, 5, 10, 15, 20 years, we don't know what is going to happen after 20 years, and as a result, we will say that there are constraints. If there are constraints, you will not include the variable consideration as a part of transaction price till the time there are constraints. Once the constraints are lifted, you can include it at a part of transaction price. Remember, you will keep on reassessing this at each balance sheet date based on the factors prevailing at each balance sheet date. Chalo, theek hai, there are no constraints. Assuming there are no constraints, then variable consideration has to be included. The question arises, at what price should it be included? Well, because it is variable, we don't have a fixed amount. So there are 2 methods which the standard permits. First is, there is an expected value method, which is a probability based weighted average. So there will be various outcomes. You will ascribe probabilities to them and you take the probability based weighted average. Typically, ICI suggests you do this when there are more than 2 outcomes. Or the most likely value method, where you have only 2 outcomes, exactly 2 outcomes. That is, if you get a gold star rating, you will get a bonus. If you don't get the gold star rating, you will not get a bonus. There's an 80% chance you get the gold star rating, in which case you will get the bonus. Then you don't need to do probability weighting. You will directly include the amount of bonus in such a case. So which method should you use? Well, management is free to use any method. It is not that 2 outcomes are the most likely he karna hai. This is what the institute tells you if nothing is given. But management can very well take the probability based weighted average if there are 2 outcomes, or it can also take most likely method if there are 3 outcomes. If the question tells you something, you respect that. However, if the question remains silent, in such a case, you will always first look at the number of possible outcomes. If there are more than 2, then the expected value method. If there are exactly 2, then the most likely method. Okay. Can the variable consideration be negative? Well, yes, of course, why not? So these are called as penalties. In case of penalties, you should also consider penalty as variable consideration, negative variable consideration, as long as the penalty is something which is considered as a part of transaction price. So the seller and the buyer might have said that if you delay beyond 5 years, you will be charged a penalty. the seller will negotiate in that, because there is a possibility that you might delay beyond 5 years as well, in which case you have considered that as a part of transaction price, in which case you will also see if the penalty is likely or not. Okay. IFRS has a slightly different treatment over here. IFRS says that penalty should be considered. We don't really see whether the penalty is inherent in determination of transaction price or not. All penalties should be considered while determining the transaction price. But that is IFRS. Achha, constraints, we have explained what the constraints are. Experience may be limited, or you don't have enough track record, or the time period may be long, or there may be factors beyond the entity's control. If there are constraints, you will not include the variable consideration as a part of your transaction price. If there are no constraints, you will include, and if you have to include, you can use the expected value method or the most likely value method in order to measure the variable consideration. Reassessment, you will keep on reassessing the possibilities of variable consideration at each balance sheet date, and if there is a change, you will consider that as well. A few special cases involve over here, which involve sales with the right to return. It had come in a very recent exam question as well, I think May 2022, where you might, in the month of March, you have sold 1000 units with a return period of 1 month. You don't know whether these goods will ultimately be returned or not. So old standard says you wait till the time the return window closes. The new standard says you look at your past experience, and based on past experience, if you believe that these are 1000 units, out of which 80% will not be returned, 20% for example will be returned, then you can recognize revenue to the extent of 800 units. Let us say the selling price is 10 rupees per unit, and hence you can recognize 8000 rupees worth of revenue. What about the remaining 200 units? Well, you have received money, but if you expect that this will be returned, in which case you will create a refund liability. So your entry will be bank account debit, let us say 10,000, you have received the entire 10,000, to sales, let us say 8,000, to a refund liability of 2,000. But remember, you issue a refund only when you collect the goods back. So you will also show goods lying with the customer or a recovery asset for these items. These goods lying with the customers will be at the lower of cost or NRV. They are, for all practical purposes, your inventory, just that they are not in your godown, they are lying with the customer. So we don't have to wait till the time the return window closes. You can recognize revenue based on your expectation, based on your past experience or industry trends. So this is sales with the right to return. There's a very interesting discussion also involving warranties. Now typically, how will you account for warranties? Well, the standard over here segregates warranties into two types. It says there can be certain warranties which are service type warranties, certain warranties which are assurance warranties. Meaning, if you are, let us say, a watch manufacturer like Fossil, now you are selling watches along with warranty. But are you selling warranty separately? Are you giving extended warranty or selling warranty separately? No, you don't. Then why are you giving that warranty? Because you know your product is flawless. However, the customer does not buy the product unless he sees an assurance. So you are giving a warranty as an assurance के भाई ठीक है यार तुम खरीद लो, अगर कुछ issue भी होता है, we will repair it. So your main objective is not to render a separate service or earn income in the form of warranty, but to facilitate a sale of product. These are called as assurance type warranties. Secondly, there can be service type warranties, which are warranties which are in the nature of a separate performance obligation, like you are rendering a separate extended warranty or a separate warranty service to customers who want as well. Now, in such cases, you are treating warranty as a separate service, a separate performance obligation. So how should the accounting happen? Well, if it is an assurance type warranty, the standard says that this is a warranty which is very closely linked to the product, and hence you will not show it separate. It is highly interrelated with the product, and hence you will recognize the entire revenue at the time of product sale only. You will not separate out, treat performance warranty as a separate performance obligation. But then in your P&L, do you recognize cost? Well, you recognize COGS to the extent of the cost of the product, but repairs are going to happen in the future. So the standard says you are not going to recognize warranty income in the future. Whatever is the income you have recorded today along with the sale of the product. So you today create a provision for warranty expenses. So let us say 30,000 is the product sale amount. The cost of goods manufacturing is 20,000, and repairing, you are thinking another 3,000 of cost will be incurred. You will create a provision for repairs today itself, recognize the cost as manufacturing cost 20,000, repair cost today of 3,000, and then recognize the full revenue of 30,000. On the other hand, if it is a service type warranty, we will say that you will recognize income for this warranty as and when time passes, when the warranty services are rendered. Let us say over the next 2 years. Let us say on a standalone basis, you are giving 1 year warranty at 2,500 rupees. So out of the 30,000, you can say 2,500 and 2,500, that is 5,000 is attributable to the warranty. And hence, you will say that your revenue recognized today will be only to the extent of 20,000 cost of the product manufactured and 25,000 of the product revenue. Sir, what about the 3,000? Well, you will not recognize a cost today. You will recognize cost as and when it is incurred. So let us say in the first year 1,500 cost is incurred, you will recognize that as cost and there will be a separate warranty income. Similarly, in the second year 1,500 cost and a separate 2,500 warranty income. For example, if this is a customer having an option to purchase warranty separately, here the customer has if the customer has option to purchase separately or customer does not have option to purchase separately. If it does not have option, then typically this is an assurance type warranty. If the customer has an option, then it is typically like a service type warranty, which you treat as a separate performance obligation. Assurance, there is no separate performance obligation. Okay. Next, there is an important section over here which involves significant financing component. This is special guidance over here that if the time gap between the performance obligation getting discharged and the consideration being received, if the time gap over here is greater than 12 months, and it can be greater than equal to 12 months, it can be on either side. It may be that you have rendered the performance obligation, that is you have delivered the AC today and the customer is going to pay after 2 years. So the time gap is greater than 12 months, or the customer has booked a flat and you will give the keys to the flat after 2 years. In either ways, the gap is more than 12 months. If the gap is more than 12 months, there is an inherent assumption that there is a significant financing component involved if a significant amount of consideration is paid. If barely out of 1 crore property, 1 lakh rupees is paid, it's barely 1%, we don't treat it as material. But out of 1 crore property, the entire 1 crore rupees is paid. And the property is going to be delivered after 2 or 3 years. That is to say that the customer is implicitly giving you a loan. You are going to discharge your performance obligation after 2 years. So ideally, he should pay you money after 2 years. He is paying it to you today. So it is as if you are receiving a loan for which there will be a finance cost. Or if you have delivered the AC today, the customer should pay you the money today. Customer is paying you after 2 years, which means you are giving a loan to the customer, in which case there will be a separate finance income as well. So if the time gap between the two is greater than or equal to 12 months, in which case we will treat this as a item which is covered under the significant financing component section. So first thing you have to check is the gap between the performance obligation and the consideration more than or equal to 12 months? If yes, then you proceed further in this section. If no, then you can skip this section because the gap may be less than 12 months. In which case, we treat that the financing element is immaterial and we don't do a separate adjustment unless it is specifically required. Secondly, the standard over here says, and it's a new standard, it says that merely because it is more than 12 months, it does not necessarily mean that there will be a financing component involved. There can be certain exceptions over here. The exceptions over here may be that the gap is for a factor which is other than time. For example, there's a performance guarantee, or you will pay the amount after you do a test. For example, you have ordered missiles, and these missiles have been delivered, but they will be first installed into your system and test fired, and once the test fire happens, that is when you will pay the amount. But the entire process of installation, the missiles, and then clearing a site, preparing a site and doing test firing takes 16 months. So the gap is between the missile delivery and payment is more than 12 months, but that is due to a factor other than time. So it's not that there is a loan, but it's a factor other than time. Or in a lot of coaching institutes, they collect money in advance. Largely, it is not because a coaching institute may not have enough money, but it is because an institute is kind of worried that the student might later drop off. The same is the case with warranty. A lot of money is collected upfront because they are worried that the customer might later drop out. So these are due to factors other than time. Or it may be that the time gap is more than 12 months because I don't know how much is to be paid. It's based on a sales-based royalty. Like J.K. Rowling has written a book, let us say Harry Potter. She gives a license to a publisher like Snow White or Penguin Publishers, and these publishers say that, okay, I'll give you a percentage of the copies sold, but the copies have not yet been sold. So till the time those copies are actually sold, we don't know how much is to be paid. it will take around 2 or 3 years. And as a result, the gap is due to a factor other than time. Or there's a prepaid connection that you buy. A Vodafone gives you a prepaid connection. You don't activate the connection for 2.5 years, and then in the 3rd year you use it. Now, Vodafone was ready to render service. You did not take it. That does not mean that there is a loan that you have given to Vodafone. So there are 3 exceptions. First, the time gap is due to a factor other than time. Second, other than loan. Second, the difference is due to sales-based royalty, variable consideration. Third, if the service is something which can be used at the discretion of the customer. In such cases, you will not do a time adjustment even if the gap is more than 12 months. Now, if it is not covered by the exceptions, then you will do a time value adjustment. At what rate should you do the time value adjustment? Well, the first preference over here is the rate on a separate financing transaction. So, if you as a seller were to enter into a separate financing transaction, that is, if you were to give a loan to someone, or if you were to take a loan from someone, at what rate would that transaction happen? That is the rate. If that rate is not available, then the second preference is the IRR, the rate at which the present value of cash outflows and inflows equal. Sir, why is this hierarchy important? Because hierarchy is opposite under Ind AS 116. Under Ind AS 116, the first preference is the lessor's IRR, second preference is the lessee's incremental borrowing rate. Here, the first preference is your incremental rate. And if that is not available, then the second preference is the IRR. So you have to keep that in mind. Okay, so this is about your significant financing component. So next part involves non-cash consideration. This is barter. Barter was also earlier done in Ind AS 16, Ind AS 38, Ind AS 40, etc. But here the terms and conditions of barter are slightly different. So when we are looking at barter, barter over here is considered to lack commercial substance. If the barter is lacking commercial substance, we say that it is not an accounting contract in the first place. If it is not an accounting contract, then Ind AS 115 on revenue does not even apply. So over here, if the barter lacks commercial substance, then there is no revenue recognition. Inventory balances can at max be adjusted, otherwise there is no revenue recognition. But if the barter, let us say, has commercial substance, then how will we do the working? Well, if the barter has commercial substance, then you will recognize the barter considering the fair value of the consideration received. Now, the first preference is given to the consideration received, which is different from Ind AS 16 and 38, where we look at the value of the asset received based on the fair value of the asset given up. Typically, we are trying to find in Ind AS 16 the value of the asset received, which is based on the value of the asset given up. But here you are trying to find the value of the asset or the revenue, which is based on the asset which is going out, which has to be based on the consideration that you are receiving. You might be having certain goods which have a fair value of 500 rupees. You are selling them and getting consideration worth 600. Well, then the revenue is 600. You are selling them and getting consideration worth 400. Well, the revenue is 400. So your first preference here is, if the above is not available, then the standalone selling price of the goods. So, the first preference is the fair value of the consideration received. This is based on the fair value of the consideration received, and if that is not available, point 2. If the above is not available, then the standalone selling price of the goods given up. In PP, remember, you recognize PP account debit. So the amount over here is to be based on the other value, which is value of the asset given up. However, here you are recording something account debit to, let us say, revenue. The revenue over here again is based on the other item, based on the fair value of what you are receiving, and if that is not available, then the standalone price of the assets given up. You need to remember that if the consideration comes, let us say, regularly in the form of items which fair values might differ, like you might take a magazine subscription, and in return of that subscription, against each week's magazine, you are going to give 100 of your own equity shares, then you will recognize revenue based on the fair value of shares received at the end of each week. Subsequent to the receipt, the shares will be financial assets, will be recorded using FVTPL or FVOCI. But you will recognize the revenue based on the fair value of the shares that you are receiving. Okay. Next, you have consideration which is payable to the customer. Now, this is the last part when it comes to your step 3. Last of the special case, consideration payable to the customer. Typically, the consideration is payable by the customer, not to the customer. However, in certain cases, the consideration may be payable also to the customer. Like, for example, you might have Amazon or Flipkart, which might have the Big Billion Sale. And as a part of that sale, Flipkart, which is a customer, is buying, let us say, 1,000 phones from, let us say, Apple. Along with those 1,000 phones, we are agreeing to pay, let us say, 1,000 into, let us say, 1 lakh. Let us say we are agreeing to pay 10 crores for these phones. At the same time, Flipkart tells Apple that they are going to do advertising for the phones, and as a result, Apple has to pay to Flipkart for the advertising, let us say 1 crore. Now, in such a case, should you recognize in the books of, let us say, Apple, who is a seller, should you recognize sales of 10 crores and then advertising cost of 1 crore, or should you recognize the net sales directly at 9 crores? Well, it depends. If Flipkart is giving us distinct service like advertising to Apple, where it promises that it will do exclusive marketing for Apple's products, in which case you can show the advertising cost separately to the extent of the fair value. Any amount beyond the fair value, let's say the fair value of these advertisements is only 20 lakhs, then the remaining 80 lakhs will be reduced from the sale price, and you would say 10 crore minus 80 lakhs, that is 9.2 crores will be the total sales value. On the other hand, if the fair value itself is 1 crore, then you can show 1 crore as advertisement and let us say 10 crores as sales. However, if Flipkart says, well, we don't know whether we will advertise your product or not, whichever product has the best offer, we will advertise that. Maybe yours or maybe not yours, but you have to pay me 1 crore, in which case I'm not getting any distinct benefit. And as a result, we say that if there's no distinct benefit, you will directly reduce the 1 crore from the amount of revenue. So over here, in such cases, you will recognize revenue directly at the net 9 crore. So for distinct goods or services, and if there are no distinct goods or services, then the entire amount should be reduced from the transaction price directly if there's no distinct service that is received. However, if there are distinct goods and services and the consideration, let us say, is less than the fair value, if the consideration over here is less than the fair value, like for example in this case, the consideration is over here, let us say consideration is, let us say, 1 crore and the fair value is 20 lakhs, then up to the fair value, record distinct expenses, that is up to 20 lakhs, and excess, that is 80 lakhs, to be reduced from the transaction price. If it is up to fair value only, then expenses are accounted separately, no separate revenue adjustment is to be done. This takes care of your step number 3, the longest of the steps. The next step is step number 4, which involves allocation of transaction price. How will the transaction price be allocated? Well, the transaction price is allocated based on the standalone prices. Now, the standalone prices, how do you determine the standalone price? The best way to determine standalone price is your observable price if this was the only standalone obligation. So, if I were to give warranty, what was the standalone price if I were to only give warranty? That is my standalone price. However, if standalone selling price is not available, that is observable price is not available, then you can use other techniques like you can look at the competitor's price and do some adjustments to find your standalone price, or you can look at the cost of the products, to that you add the margin to find the price of the products. And if that is also not possible, you can use any other technique whereby you can find the price which you reasonably expect to receive on your products. So you will try to allocate the transaction price in the ratio of the standalone prices. And if the standalone prices are observable prices, that is the best. If that is not available, you can use other techniques as well. One of the techniques can also be residual approach. What do you mean by residual approach? It means leftover, which means, let us say there is AC, there is servicing, and then there is warranty. For all of these together, let us say 20,000 rupees is charged. On a standalone basis, you typically charge 2,500 for warranty. So you can say, okay, 5,000 is charged for warranty. On a standalone basis, you charge 1,000 for the servicing. And as a result, we can say that, let's say AC, Voltas does not sell standalone. In which case, we can take the balancing figure. We can say that, okay, if 20,000, let's say 5,000 is towards warranty, 1,000 is towards servicing, that means the remaining 14,000 must be towards AC. Remember, a residual approach is possible if the product does not have an observable price, or the product has an observable price, but it is in a very wide range. Sometimes you have sold at a very high price, sometimes at medium price, sometimes at low price. You don't have a clear observable price. That is when residual approach will be suitable. So what are the principles in step 4? Step 4 says you will allocate the transaction price in the ratio of standalone prices. The standalone prices will be based on the observable price or other valuation techniques. In certain cases where you don't have a separate standalone price, or you don't you have a price which varies in a big range, in which case you can use a residual approach as well. Few things have to be taken care while you are doing the residual approach. First, you have to allocate discounts, if any, before you do the balancing figure. So first you will have to allocate discounts and then do the balancing figure. So if there are any discounts in servicing and warranty, you first allocate them and then do the balancing. Second, once you find the balancing figure, that has to be within range of what you reasonably expect to receive. So if you are selling in a range of, let us say 15 to 18,000, or let us say a different range altogether, if 14 is outside that range, then that is not an amount that you reasonably expect to receive, and hence you'll have to use another method to find the standalone price. You cannot take the residual approach. So what are the general principles? The allocation will be in the ratio of the standalone prices. However, there are two exceptions to this rule. First, if there are discounts. Now, typically discounts can also be allocated in the ratio of standalone price. Like you take, let us say, a combo from a particular faculty, in which case, let us say you are taking 4 subjects together. The price of the combo is going to be in all cases lower than the price if you were to buy 4 products separately for one group. So there is a discount. Now this discount is allocable to which performance obligation? Well, it is to all the 4 promises in the ratio of their standalone prices. However, if a separate combo is sold and that is having a particular discount allocation, then you will first allocate the discount to the combo. Like for example, in this case, let us say there is servicing and then there is warranty. However, a combo of service plus warranty, both of them together, is available, let us say, at 5,000 rupees. Or let us say 5,500 rupees. In which case, you will first allocate the 500 of discount. So ideally the total over here is 6,000. You will allocate it to the service and to the warranty in the ratio of their standalone prices. So 5,500 या फिर 500 of discount into 1/6 towards servicing, 500 of discount into 5/6 to, let us say, the warranty. Let me just make it simple. It is, let's say, 5,400 together. If both of them are taken, let us say this comes at 5,400, in which case 600 is a discount amount, and if I were to allocate this, it will come to services 100 and 500 towards warranty. So you will have to allocate this discount directly to servicing, which is 100, and to warranty, which is 500, and hence if I total this will come to 900, this will come to 4,500, and hence the total comes to 5,400. So you will allocate the discount in the ratio of this smaller bundle, and then if I have 20,000, then the remainder after this allocation will go. So this is 20,000 minus 900 minus 4,500, then 14,600 will be allocated to the air conditioner. Again, after this 14,600 is done in the residual method, if you are following that, you will see whether that is an amount that an entity reasonably expects to receive. So an exception to allocation to all the performance obligations can be discounts. Second exception will be variable consideration. Now it might be that you have 2 promises. Promise number 1, construction of a bridge. Promise number 2, maintenance of a bridge. There is a performance bonus given where it is told that if you construct the bridge within 3 years, you will get a construction bonus, a early completion bonus. Now this is directly attributable only to the construction obligation. It does not have any connection to the maintenance obligation, and hence ideally this variable consideration should not be allocated in the ratio of standalone prices. However, it should directly go to the construction part only. Nothing of this should ideally go to the maintenance. It should directly go to the construction part because it is directly attributable to that. So ideally, when you look at allocation, the allocation will be in the ratio of standalone prices. This is the core principle. Allocation should ultimately result in prices which an entity reasonably expects to receive. And the exceptions to this, would be discounts which can be allocated to the smaller bundle if there is discounts which are attributable to only servicing and warranty. And second is variable consideration, where you will allocate the variable consideration ideally to the performance obligation to which it pertains. However, in doing such an allocation, you have to ensure that the value that you get after doing the allocation should be a value that an entity reasonably expects to receive. If the allocation results in a number which an entity does not reasonably expect to receive, after applying those exceptions, you will then have to allocate in the ratio of standalone prices to ensure that you get a number which an entity reasonably expects to receive on these promises. Okay, so this is largely pertaining to the allocation, with two exceptions, one being discount, one being variable consideration. Standalone selling price is preferably the observable price, and if that is not observable, then adjusted market price or cost plus margin, or even the residual approach, that is a balancing figure. While doing residual approach, you have to ensure that you can use this if the entity has a very broad range of standalone prices, or the entity has never sold the goods on a standalone basis, in which case a residual approach can work. While doing so, you have to remember that you first allocate the discount before the residual approach is applied, and the amount after. All of this, that is a balancing figure that you get, should be an amount that an entity reasonably expects to receive. Okay. Now, this is a fairly complicated topic, customer options for additional goods or services. This is linked to items like gift vouchers, discount vouchers, customer loyalty points, rebate coupons, etc. What is a typical example for this? Let us say you go to a company like Shoppers Stop and you buy a shirt, let us say for 10,000 rupees. Shoppers Stop says that for every 1 rupee spent, you will be given 1 point, and the value of 1 point, let us say, is 10 paise. So against this 10,000 rupees of spent, Shoppers Stop is under an obligation to give you 10 points, and the value of each point is, let us say, 0.1, in which case the value of these points is 1,000 rupees. What can you do with these 1,000 rupees? You can actually redeem these 1,000 rupees in the future. So when Shoppers Stop is actually selling the shirt to you today and getting 10,000 rupees, it is discharging a performance obligation of delivering the shirt today itself. However, it is also giving you coupons, and these coupons also have a value. Coupons, vouchers, points, they have a value. The value over here is 1,000. And against this, the customer can come back in the future and buy, let us say, some other product, let us say a bag. And as a result, when we are looking at the performance obligations that Shoppers Stop has a performance obligation to give a shirt. That is one promise, and second, to give points. Now, these points are also not free. I mean, like gift vouchers, discount vouchers, you can have these vouchers which are also chargeable. So over here, for both of these, the customer is paying 10,000. If you give only the shirt against 10,000, the customer can sue you because you are under an obligation to give even the points. So how much is the value attributable to shirt and how much is attributable to points? So if I were to look at shirt alone, had there been no such loyalty program, 10,000 is the standalone price for a shirt, and 1,000 if someone came to buy these points. Theoretically, 1,000 should be the consideration for the points. So for both of them together, the customer is paying 10,000, and hence you will allocate. So if you have to allocate, you will allocate a transaction price of 10,000 in the ratio of 10:1. So this is 10,000 into 10 by 11, which is equaling to 9091, and 10,000 into 1 by 11, which is equaling to 909. So what will be your entry? Your entry will be bank account debit, let us say 10,000 we are receiving today, to sales to the extent of shirts sold, which is 9091, to customer loyalty point liability. Sir, why is it a liability? Why is it not sales? Well, you're not in the business of selling points. These points are like credit notes. You're giving those credit notes against which a customer can come in the future and they can buy, let us say, a bag in the future. The customer will not again pay. So customer is paying you 10,000, let us say, for a shirt which you have delivered, and a bag which you have not yet delivered. So when the customer comes and takes that bag, your entry will be CLP liability account debit. let us say 909, the credit note is utilized, the points are utilized to sales worth 909. So in total your sales are worth 10,000, but they are to be recorded as and when the performance obligation is discharged. That is when the shirts are delivered, and that is when the bag at a later date is delivered. There can be various different possibilities, like a discount voucher or a gift voucher. In case of a discount voucher, you will have to predict that how much will the spending happen, how many customers will actually redeem and utilize a discount voucher, what is the real amount of discount, like you might have given a 40% discount voucher. However, the store has a flat 10% offer going on, but you can't club both of them. Then the real value of the discount is 40 minus 10, that is equal to 30% only. So you will say that, okay, I have also given a discount voucher which the customer can use against future shopping. How much future shopping will he do? Let us say 1000, then 1000 into 30%, that is 300, will be the benefit that he will get. Again, not every customer might come and redeem. So how many customers will come and redeem? Let us say 80% of the customers. Hence, by using all of these variables to the extent they are available, you will try to find the fair value of the discount voucher or the standalone value of the discount voucher. So Institute has a few questions on these lines. The solutions are slightly differing in each of them, but largely, if you want to follow consistent base, if the same question comes, follow the Institute's version. But otherwise, you have to find the performance obligations, which can be the shirts as well as the points, allocate the transaction price in the ratio of the standalone prices. You will determine the standalone prices of these, and then recognize a liability when the points are given. Once these points are redeemed, that is when you will recognize the sales. If there are discount vouchers, then you will try to find the material benefit that is given by the discount voucher, the real benefit that is given by the discount voucher, and based on that, you will measure the value of the discount voucher. So that takes care of your step number 4. Hello everyone, and welcome to the next session for Index 115 concepts. In the last session, we discussed about the need for the new standard as well as the first 4 steps in the revenue recognition framework. Today, we discuss about the 5th step, that is recognition of revenue. When should you recognize the revenue? Well, revenue should be recognized when the performance obligation gets discharged. Okay, excellent. But when is performance obligation getting discharged? Well, the standard says that the performance obligation gets discharged when the control is transferred. So typically, you will recognize the revenue when the performance obligation gets discharged, which is when the control is transferred. A definition of control is given, where typically we say that the buyer gets the ability to do what the buyer wants with the goods and services. That is when the control is transferred. Or at least the buyer gets that ability to prevent others from doing what they want to do with the asset. So over here, revenue recognition will be, so we have revenue recognition when the performance obligation gets discharged, and performance obligation gets discharged typically when the control is transferred. Control is transferred to the buyer when the buyer can do what he wants to do with the asset, with the goods, with the services. They want to transfer it to someone, they want to keep it, they want to modify it, or they can prevent others from doing what they want to do with these goods and services. So the law says that the control can be transferred in one of the 2 ways. The control can be transferred, let us say, over time, or the control can also be transferred at a point of time. When can we say that the control is transferred over time? The standard over here gives you 3 criteria. It says that, well, the control can be transferred over time if there's a simultaneous transfer. So the provider provides those goods and services and the recipient consumes it simultaneously. Like for example, in case of a coaching institute, if you are, let us say, attending a face-to-face session, or let us say you take a gym membership, the provider provides services and the consumer consumes those immediately. Okay, sir, we don't understand when this will happen. Like for example, the law tells you that there will be a simultaneous transfer if, hypothetically, if midway the contract was to be terminated and instead of the old service provider, a new service provider comes in, the new provider will start where the old provider ends. So sorry, I'm really sorry. So in case of coaching, let us say if midway through you want some other teacher, then typically a new teacher will start where the old teacher left. Or in case of a gym membership, if let us say there was a 12-month membership and after 3 months a new gym takes over, the new gym will give you the balance subscription for the remaining 9 months. Now it does not really matter whether you attended the class in the first 3 months, you attended the gym in the first 3 months, it does not really matter. There was a simultaneous transfer. The service provider was and he was willing to give service over the first 3 months, so there was a simultaneous transfer. So criteria A mentions that there should be, let us say loosely speaking, a simultaneous transfer. Second, the second criteria says that there should be a significant customization or modification that you're doing on the customer's asset. So for example, you are working over here on the customer's asset, like you are doing a painting job or a renovation job, you're doing it on the customer's asset. So if after a few days, let's say you have a 5-bedroom house and you are doing a painting in that 5-bedroom house, well, after 3 days, 3 bedrooms, if you don't want the painter, well, the painter has worked on the customer's asset and hence the customer gets the benefits. So over here, in case you are working on the customer's assets, on an asset owned by the customer, in which case we will assume a criteria be getting satisfied and hence the revenue will be recognized over time. And the last case over here is the most important case, where let us say your products or your goods and services have no alternative use. This may be because the nature of the product is such that no one else can use it. Like for example, satellites, they are so heavily customized for a particular user that no one else can use it. Or there are legal restrictions or constraints where you cannot transfer it. Like if India has ordered Rafale jets from, let us say, a French company Dassault, India has clearly mentioned in the contract that you cannot transfer these jets or this similar technology to someone else. So over here, there is no alternative use, either due to legal restrictions or due to commercial compulsions. You cannot, as a service provider, use this for someone else. Plus, the seller will be compensated based on the work done, compensated based on work done plus a reasonable profit margin. So the compensation will be based on the work done plus a reasonable profit margin. So if either of these get triggered, the revenue is supposed to be recognized over time. We'll just do a little more detailing for each of them, like simultaneous transfer. So in case of a coaching industry, you're doing a simultaneous transfer. That is, if hypothetically an old teacher goes out, the new teacher will start where the old teacher left. However, if there's an audit assignment, just before signing an audit report, if the auditor is uncomfortable, the new auditor will substantially redo the entire assignment. He will not start where the old auditor left. So this is simultaneous transfer. Even under the old accounting standard AS9, the revenue under these arrangements was recognized over time only. So there's no real material change except for being a clarification. Second, if you are working on the customer's assets, this was typically construction contracts AS7. Even over here, construction contracts, you are constructing or working on the customer's assets. Even in these cases, in general, you would recognize revenue based on the stage of completion method only, and hence revenue recognition even under the older standard was happening over the period of time. However, the key introduction over here is the third point, where you have been told that if you are doing a work which has no alternative use, like for example, if you are doing audit for a particular company, you can't sell that audit assignment to someone else. I mean, the work that you have done, you can't really sell it. You have no alternative use. There is a commercial compulsion or a legal restriction, and the seller and the buyer has told you that they will compensate you based on the work done plus a reasonable profit margin. It is not a random compensation, it is not a flat compensation, it is compensation based on work done. Like for example, when India ordered Rafale jets from a French company Dassault, let us say Ind AS was applicable to Dassault, then before Ind AS, if AS was applicable, you would wait till the time the aircrafts are actually delivered. And that is when Dassault would recognize the entire revenue. However, under Ind AS, one can say that, well, the aircrafts that Dassault is making, it does not have any alternative use for Dassault. You can't sell it to anyone else. Secondly, the Indian government has mentioned that it will compensate Dassault in the event of termination. It will compensate Dassault based on the work done plus a reasonable profit margin. It is not just a meager compensation. It is based on work done. If you have not done work, you will not get compensation. If you have done substantial work, you will get substantial compensation based on work done. And hence, the standard says, what is the point in waiting till the time you actually deliver the keys? You can recognize revenue because hypothetically, even if the contract is terminated, you are entitled to the benefits. And hence, in such cases, revenue recognition is going to happen over a period of time, which is a marked departure from what you do under accounting standards, where revenue is in such cases typically recognized at a point of time. Okay, next, when do you say, so do all the conditions have to be satisfied? No, any one of them is satisfied and that is enough. So when do we recognize revenue at a point of time? Well, it is a negative definition. That is, if the revenue is not recognized over a period of time, then it is considered to be recognized at a point of time. Now, what is that point of time? Well, typically the point of time is the point of time when legal ownership gets transferred, delivery of the goods is taken, risks and rewards are transferred. So you will recognize revenue at a point of time. Remember, this is a negative definition. That is, if the control is not transferred over time, then it will be considered to be transferred at a point of time. Now, we will focus on the revenue recognition. So this is the general theory about control. Each of these criteria is being explained, and then in case the revenue recognition is over time, you will have to measure progress. That is, how will you recognize revenue? Well, it depends on progress, and progress is measured either using the cost to cost input method or using output method. So over here, what do you mean by input method? Under the input method, you will compare the cost incurred till date and divide it by the total estimated cost. Like, let us say you are a real estate company, you have a 100 crore project, you are expecting to incur 100 crores, or let us say you have a project which is, let us say, having 100 flats, and these 100 flats you are expecting to sell at 1 crore each, in which case the output is 100 crores. And the cost of this project is expected to be around 80 crores. Now, let us say at the beginning, you have dug up the foundation, you are making the base, etc., and you have incurred 20 crores during the year. You have just made 4 flats. Maybe you have just made the first floor and 4 flats, but you have incurred 20 crores. So the input method would say, well, 20 crores out of 80 crores, and as a result, 25% of the project is complete. You can recognize 25% of the revenue. Whereas output method would say, well, out of the total 100 flats worth 100 crores, 4 flat worth 4 crores are ready, and hence the stage of completion is only 4%, and hence you can recognize revenue to the extent of 4% only. Sir, which method should you follow? Well, it depends on the facts and circumstances of each case. The question should ideally guide you. If nothing is given, you will always follow the input method, because the cost incurred upon total estimated cost will typically be given to you. Sir, when will you know that it is an output method? Well, if the question tells you a particular surveyor's report or an architect's reports which gives you valuation or a percentage of completion, that is when you will take the output method. In all other cases, you will stick with the input method for the purpose of revenue recognition. Sometimes it might happen that the inputs are to be incurred almost evenly. Like in a coaching institute, if it's a 12-month batch, the inputs, the cost like rent, faculty cost, stationery is almost evenly spread over the 12 months, in which case the standard permits you to recognize revenue on a straight line basis. In such case, like even gym memberships, the cost incurred by the gym is almost equal, and hence the revenue can be recognized in such cases on a straight line basis. However, you will have to figure out first if the progress is to be measured, ideally using the input method or using the output method. If the cost is incurred almost evenly, the benefits are accruing almost evenly, in which case you can even use the straight line method, but otherwise you will have to take the input or the output method, typically the input method. Now, in certain cases, you might also need to do adjustments to the input method if required, like if, for example, there is a major abnormal loss. You purchased raw materials and then there is a flood or a fire. The materials get destroyed. Will that go into the cost incurred calculation? Answer is no, because abnormal loss does not contribute to progress. Well, you might have spent 5 crores and that 5 crores gets washed away. However, that does not mean your project is progressing, and hence abnormal loss should not be a part of your cost. Secondly, when you take the cost, it has to be cost incurred. Merely raw materials purchased is not sufficient. The raw materials have to be consumed. You just buy cement bags and keep it. That does not mean your project is progressing. You will take it only when the raw material is consumed. And thirdly, there might be certain cases like elevators or major assets that you are buying in the land or in the building where you don't have any other performance obligation except for buying it from a third party and directly installing it. In which case, these are major contributories to the cost incurred. However, that does not really reflect how much work you have done, and hence the standard allows you to segregate them. So it says you measure the stage of completion for these major assets which you are responsible for merely purchasing. Again, in the name of the customer, you are just responsible to merely install it, in which case you will separate them from the other cost, and your progress will be measured based on the other costs. So for example, if it's a 40 crore project, out of which 15 crores is the cost of the elevator, that's a substantial amount, maybe around 30-40%, in which case you will segregate and you will say, okay, you might have spent 15 crores in buying elevators, but that does not mean the project is, let us say, 40% complete. So you will segregate that and you will say, okay, out of 40, 15 crores is towards the elevator, the remaining 25 crores is towards the other part. Out of this 25 crores, how much money have you spent? Let us say 5 crores. Then you have spent 15 for the elevator in the current period and 5 on the other part. So your progress will be measured not as 20 divided by 40 and 50%, it will be measured as 5 divided by 25. Let us say that is 20%. For the elevators, you will recognize the cost, and whatever is the cost incurred will be the revenue. So when you are preparing the P&L, you will have cost incurred for the elevator 15 crores, revenue to the extent of 15 crores booked. Secondly, you will have other cost of 5 crores, and due to that, let us say your total revenue was 50 crores. Out of 50, we are allocating 15 to the elevators, and the remaining 35 is for the other items. Then 35 may say 20% is done, so 35 into 20%, 7 crores will be the revenue recognized. This is similar to an illustration that we will do. So over here you have to be careful about the adjustment that might be done in the input method. Okay, other things like excluding abnormal loss, taking materials when consumed, etc. have been discussed. When should the revenue be recognized at a point of time? Well, if it does not meet the over the period of time criteria, all the 3 criteria are not met, then at a point of time. Typically, the point of time is when the delivery is given, the legal title is transferred, the risk and reward is transferred. A few special cases that you will study. First is sale and repurchase, also called as repo transactions, in which case you are selling the goods and there's an agreement to repurchase. Typically, if there's a compulsory agreement to repurchase like a forward contract, then in all likelihood, the control of the goods is not transferred because a buyer cannot do what he or she wants to do with the goods. Then why are we entering into this transaction? Well, probably if the goods are worth 100 and the same goods you're agreeing to buy at 110, let us say after 1 year, the standard presumes that this might be a loan transaction where you are giving the goods as security, and hence instead of passing the entry bank account debit 100 to sales 100, we'll pass the entry bank account debit to loan, let us say 100. Then we are buying back at 110, so that's not a purchase. In fact, that's a repayment of loan with 10 rupees as interest, in which case your entry will be interest account debit 10 to, let us say, loan 10, and then at the end of the year when the repurchase happens, your entry will be loan account debit 110 to bank 110. This is provided the repurchase is happening at a price which is higher. In certain cases, it is also possible that the repurchase happens at a price which is lower. For example, you are repurchasing at 90 now. Why would you sell at 100 and repurchase at 90? Well, probably because the buyer wants this asset and the buyer is willing to pay rent. However, you also accept a security deposit, and as a result, it is likely that the 90 that you are returning at the end of the period is a security deposit when the asset comes back to you. However, the 10 rupees is rental income, in which case your journal entry will be bank account debit to security deposit. You are receiving the security deposit and giving up the asset, bank account debit 100 to security deposit 90 to unearned rent income, let us say 10. You are the lessor, so rent income for you. And then over the 1 year, you will pass the entry unearned rent income account debit 10 to rent income, which goes in the P&L, 10 rupees. At the end of the year, you will have a security deposit liability worth 90. The lessee gives you the goods back. You give the security deposit back. Your entry is security deposit account debit 90 to bank 90. This is provided there is a repurchase commitment. We have done both the cases. The sale and repurchase can be at a price which is higher, in which case it's a loan, repurchase can be at a price which is lower, in which case it is a lease. However, this is where there is a compulsory repurchase requirement. However, in certain cases there might be a repurchase option, like the seller might have a call option to buy these goods back, or the buyer might have a put option to sell these goods. Now, in these cases, it is very difficult to say that this was necessarily a loan or necessarily a lease, because in all likelihood, the exercise might not happen, in which case the control is transferred. So, you cannot blindly override the legal form. Sir, then how will we account for it? Well, you will try to look at the essence. Does it appear to be having a significant economic incentive that the exercise will happen? So let us say the repurchase price is 110, or let us say the repurchase price is 90, and you have a call option. You are expecting that the market price of the products that you have given up is expected to be close to 200. So it is highly likely that you will exercise the option and buy at either 110 or 90, as the case may be. And as a result, in such cases, we would say that the transaction over here is much more likely that the repurchase will happen, in which case you will continue to treat it as a loan or a lease, as the case may be. However, if the repurchase price is 90 or 110, as the case may be, and you are expecting the market price to be 50 rupees after 1 year, in all likelihood you will not exercise the repurchase option. Well, if you don't exercise the repurchase option, in which case the repurchase will not happen, in which case this is a genuine sale. Your entry will be bank account debit 100 to sales 100. Sir, but what if the repurchase happens? Well, if the repurchase happens, then purchase account debit to bank. You will not really show it as a loan or a lease, because we don't think that there's a significant economic incentive to exercise. The same can also apply in case of a put option which is with the buyer. Put option is the right to sell, call option is the right to buy. In which case the buyer might have a right to sell, but will the buyer exercise that right? Well, we don't know. Again, you'll have to assess initially whether there's a significant economic incentive. If there's a significant economic incentive on the buyer to exercise, then the goods will come back to you, in which case you will treat it either as a loan or as a lease. However, if the buyer does not seem to have an economic incentive to exercise, in which case it is in all likelihood the buyer will not exercise, in which case the goods will not come back to you. So you will recognize it as a sale. So these are a few interesting cases. Another interesting case is a bill and hold arrangement. In this case, what happens is, the goods are manufactured by the entity, and ideally once the goods are manufactured, the revenue will be recognized at a point of time. The delivery will be taken by the customer will have legal ownership. Now, what might happen sometimes is that the customer might not have enough space to store these goods, but the customer's factory might be very close to your warehouse, and as a result, if these are like spare parts or so, the customer might say that, well, you keep the spare parts with you, whenever needed I will take it. The ownership of these goods are with me. You have to keep the goods earmarked. You cannot really give it to anyone else. However, I will take it when I want. In such cases, there is a hidden performance obligation of even custodian or warehousing services. So, for example, if it takes 2 years for me to make a particular product, I give that product after 2 years, my performance obligation is discharged. However, if I also have to store these goods for another 3 years, in which case I have another performance obligation or promise to act as a warehouser or custodian of these goods. And as a result, you will have to allocate the total transaction price between these performance obligations, which is attributed to goods, which may be at a point of time when the legal ownership gets transferred, but for custodian or warehousing services over the period of time as and when the storage is done. So this is about bill and hold. Again, a recent exam question was asked on this. Now, a new topic which has been fairly recently added, I think in 2021 or so, is on license of intellectual property. Now, the guidance that you have studied till now for transferring control over a period of time or at a point of time does not necessarily apply to the license of intellectual property, for which a separate guidance is given. So, intellectual property may be, let us say, licenses to feature films, movies, songs, track records, brand rights, etc. So, let us say I am a club like Mumbai Indians, or if I am a content creator like T-Series. Let us say I have made a song which is an old 1980s or 1990s song. A company wants license. Now, I am the content creator as T-Series. Now, there is a company which wants a license to use that song for a period of 2 years. When should the revenue be recognized by T-Series on this licensing arrangement? It is income for T-Series. Let's say the new company is paying 50,000 per month. When should T-Series recognize income? Well, it depends on whether I'm giving access to intellectual property, in which case you will recognize it over time, or if I'm giving just the rights to use intellectual property as it is, when you will recognize it at a point of time. So we don't understand. Well, it's fairly technical. Like for example, if you have a team like Mumbai Indians, which is in the IPL, now Mumbai Indians के जो t-shirts है, let us say you are a clothing company, an apparel company like Madura Garments, and you want to make t-shirts officially for Mumbai Indians with Rohit Sharma and all of these players, and you want to sell it. So you approach Mumbai Indians to get the license to manufacture t-shirts of merchandise, of bags, caps, t-shirts, etc. of Mumbai Indians for a period of 3 years. Mumbai Indians might give you a license to do that for 3 years, for which you will have to pay a certain sum of money, either upfront or over 3 years, it does not matter, because we are not following cash system of accounting. So what I am getting now is a intellectual property as a buyer. Now, will the value of this property keep on changing? Well, yes, if Mumbai Indians does really well, it signs up the biggest of the players, then the intellectual property value will increase, will keep on changing. But if it wins trophies, if it is very popular, the value will increase. However, it gets stuck up in some match fixing scandals, or if it is thrown out of the tournaments fairly quickly, then the value of the license will keep on falling. Remember, Mumbai Indians does not have any performance obligation towards you to kind of win trophies or sign up the best players. However, it will keep on doing actions which can have a positive or negative impact, and hence what you never get control over the intellectual property on the first day, or you will keep on getting you will keep on accessing the property which can keep intellectual property which can keep on changing, and as a result over here the revenue for Mumbai Indians on this license will be recognized over the 3 years. On the other hand, if let us say there is a defunct team, let us say earlier there was a team called as Kochi Tuskers, and there's still a lot of popularity about this team, let us say in Kerala, in which case this is a team which is no longer playing in the IPL, but you want to manufacture t-shirts about Kochi Tuskers and sell it, let us say, to your South Indian let us say customers, in which case you approach, let us say, the brand collector or the team and get the license. Now you are not going to get impacted by any positive or negative changes because Kochi Tuskers is not playing, and as a result you are getting control over the intellectual property from the very first day. You don't have to wait as a buyer over the period of 2 or 3 years because the value of the property is not changing, in which case Kochi Tuskers can recognize revenue directly at a point of time. Similarly, the T-Series example that we had discussed, in T-Series, the song is already recorded. You might use it, but the functionality, the song is already recorded, the intellectual property is as it is at a point of time. And as a result, over here, T-Series can recognize revenue directly at the point when the license agreement is entered, at a point of time. This is a similar case even for films. Let us say a film is already completely made and a license is given by the film owner to showcase it, let us say on an OTT platform or somewhere. In which case, the film producer can recognize revenue at a point of time because no matter, I mean, they might do marketing and they might do something, but the functionality, the content of the film does not change. And as a result, over here, the revenue can be recognized at a point of time. Remember, for this you have to remember that, let us say, there is a single performance obligation, for example, between Mumbai Indians and Madura Garments, which is to give license of that intellectual property. Mumbai Indians has no further obligation, but Mumbai Indians can keep on doing actions which may have a positive or negative impact. In such cases, the revenue should be recognized over time. Transfer of control does not happen at a point of time, it will happen over time. On the other hand, if these conditions are not satisfied, the revenue recognition will happen at a point of time. So if 3 conditions are not met, it is like a static IP, not a dynamic IP. If it's a static IP, the revenue recognition happens at a point of time. If it is a dynamic IP, the revenue recognition happens over a period of time. Okay, there's a key point over here to remember that mere advertising or giving routine updates does not make the IP dynamic. Remember, updates in all likelihood are separate performance obligations from the software itself, and mere advertising does not change the functionality of the intellectual property, and hence we cannot say that the IP is dynamic because you're going to do advertising. An expected change in the IP's values due to the activities of the licensor makes the IP dynamic. Okay. Then there is another special case which involves service concessions. Service concessions over here are like toll roads, for example, public-private partnerships. So over here, let us say there is an expressway and there's an infrastructure company like IBRCL or IRB Infrastructure which is constructing an expressway. How will expressway be recognized in the books of the company who's constructing it? Well, it cannot be shown as PP because it is owned by the government. However, how will you recognize it? Well, it depends on the nature of the agreement. If on account of that construction you have a contractual right to an unconditional contractual right to receive a fixed amount of consideration, let us say 1,000 crores, in which case this will be treated as a financial asset like government account debit or financial asset account debit to construction revenue, to service revenue. However, if the government has not promised to give you an unconditional amount of cash, but the government says, well, the Indian public has a lot of money, I will give you the right to collect toll for a period of 40 years. Now, this is an intangible asset. The right is an intangible asset for which you are going to get a future economic benefits, but you don't have a contractual right to receive a fixed amount of cash. And as a result, this against rendering construction service, the government gives you the right to collect toll, and hence it's like a barter where you're giving construction service. In lieu of that, you're getting the license to collect toll, which is an intangible asset, and you will show this as an intangible asset. So over here we need to remember that in case of service concessions in the books of the contractor, if you're getting an unrestricted right to collect cash, an unconditional amount to receive a fixed amount of cash, let's say 1,000 crores, then it's just a pure construction contract. It's like a credit sale. You recognize financial asset and construction revenue. However, if you're getting a right to collect toll, it's like a barter where you are getting a license, and this is the consideration for the construction that you're doing. So it will be an intangible asset which will be recorded in your books. Okay, so that largely takes care of the 5 steps and the special cases. There are 2 more things, I guess, in the standard. One pertaining to contract modification and second pertaining to contract cost. We'll first finish contract cost and then go to contract modification. All throughout we have kind of focused our discussion solely around revenue. However, there can be certain costs which can be incurred either for obtaining the contract, called as contract acquisition cost, or for fulfilling the contract, also called as contract fulfillment cost. So typically the older standards did not have any guidance, and hence you would recognize the expense as and when they are incurred. However, that in some cases might affect the matching concept, like you might incur the contract acquisition cost at the beginning, but the benefits of the contract may be spread over the 5-10 year period. But the cost is already incurred and hence it will go to the PL in the first year. So in certain cases, if they are eligible contract acquisition cost or eligible contract fulfillment cost in certain cases, then the standard allows you to capitalize these costs and defer this on a systematic basis over the average contract tenure. Before that, we need to understand what is a contract acquisition cost. A contract acquisition cost is a cost that you will incur in order to obtain or secure a particular contract. So when we look at contract acquisition costs, these are costs which will be incurred if you obtain the contract, which will be saved if you don't get the contract. So the general thought process is that any cost that you're incurring at the beginning is contract acquisition cost, which is wrong. Like there may be a sales team which is flying to a customer's location, a bid may be submitted, all of these costs are going to be incurred whether you get the contract or not. However, a salesman's commission or a brokerage or legal expenses like stamp duty will be incurred only if you get the contract. So contract acquisition costs are only the incremental costs that you will incur if you get the contract, but which will be saved if you don't get the contract. These are called as contract acquisition costs, which can be capitalized provided the contract term is more than 12 months. If it is less than 12 months, the standard says it does not make sense capitalizing and then spreading it over the 1 year period. In any case, you can directly expense it to the P&L account. So what are contract fulfillment costs? Now, contract fulfillment costs may be, let us say you get an order from Vodafone and Vodafone says that you need a specific type of computers, specific types of softwares, but you also need to migrate the data, test the data of Vodafone, design in a certain way. So you are ready to do all of these. These are costs that you are incurring in order to fulfill the terms and conditions of the contract. This is not to acquire the contract, this is to fulfill the requirements in the contract. So are these contract fulfillment costs to be accounted for under 115? Well, the standard says that if you are incurring these costs, and they get covered by a separate accounting standard. Like computer will get covered under Ind AS 16 PP, software will get covered under Ind AS 38 intangibles, but data migration and testing might not get covered in under any of the standards, and in such cases Ind AS 115 will apply. So if a particular cost is covered by a separate standard, you will account for that cost based on that standard. However, if it is not covered by any particular standard, that is when Ind AS 115 will apply, and you can capitalize it as contract fulfillment cost. Okay, what will I do with contract fulfillment cost? Again, you can spread the contract fulfillment cost on a systematic basis, which can be straight line or any other basis, over the average contract tenure. The average contract tenure is the original contract tenure plus the expected renewal. So for example, the non-cancelable tenure is 5 years with renewal possible for 1 year each. We are expecting that 2 renewals will happen, in which case 5 years plus 1 more renewal and 1 more renewal of 1 year each. So your average contract tenure is 7 years. You can spread the contract acquisition cost or contract fulfillment cost over a period of 7 years. Now this is about contract acquisition cost. Then you have contract modification, the last part. When can we say that the contract is modified? And should you account for that as a separate contract, or should you account for this as modification of the existing contract? Now this is fairly confusing and tricky as well. So when we are looking at contract modification, there are 2 things to be seen. Is there a scope in increase in scope? Like for example, you had ordered 100 pieces, now you are ordering 150 pieces. So there is an increase in scope, that's 50 more. And is that additional units at the standalone selling price at the date of modification? So is there an increase in scope of the goods and services, and are those additional items at the additional standalone selling price? If yes, you treat these additional 50 items as if a separate contract is entered, and you will record these 50 items based on the standalone price of those items, and you'll recognize revenue when the performance obligation for these items get discharged. Okay, so if both the above conditions are fulfilled, you will treat it as a separate contract. That is, there will be no effect on the existing contract. Now, you need to be very clear that there has to be an increase in scope for distinct items. Now, there may be 100 items or 100 kgs of rice, and you might agree to provide another 50 kgs of rice. A person might say, "Arey, ye to dono same hi hai, rice hi hai," but the first 100 kgs are distinct from the next 50 kgs. They are not a part of a single integration activity. They are not customizing or modifying, and they are not highly interrelated, in which case they are distinct. Like we had discussed that newspaper on day 1 is distinct from newspaper of day 2. In a similar way, the first 100 kgs are distinct from the next 50 kgs. You can very well recognize them separately. Okay. However, if one or both of the conditions are not fulfilled, then how do you account for this? If one or both conditions are not fulfilled, then you will see that the additional promise that you are doing or the change that is happening, is this resulting in a distinct performance obligation? So over here, if one or both conditions, above conditions are not fulfilled, if one or none of the conditions are fulfilled, so if only one is fulfilled or none of them are fulfilled, then you will see if the change, the modification is resulting in something which is distinct. Like for example, you might have entered into an annual maintenance contract to provide servicing every month for a period of 12 months. 6 months are over. The remaining 6 months are still remaining. Remember, the remaining 6 months are distinct from the first 6 months. In such cases, the standard says you treat it as a termination of the existing contract and entering of a new contract. So if modified performance obligation is distinct from the existing promise, then you treat it as if it is a termination of the existing contract. So you treat that, ठीक है, जो पहले 6 महीने का सर्विस हो गया सो हो गया. Now the new service will be based on the new terms and creation of a new contract. This is fairly simple. You will not adjust the revenue already recognized in the past. However, if the modified performance obligation are not distinct, for example, you are doing a renovation work, and renovation is customization of a customer's property. Now, in that renovation exercise, the customer requires you to change a few things, for which you need to now incur more hours. Now, this is a modification, but this is not a distinct promise or performance obligation, because it's a single performance obligation of renovation, in which case the standard now says that it is a modification of existing contract, where you will have to try to find the revenue to be recognized till date based on the modified terms minus revenue which is already recognized earlier. and record the additional revenue in the month of modification. You will not do a retrospective restatement because it's not a change in accounting policy, nor is it a prior period error. However, because there's a change in a single promise, you will have to restate the amount of revenue that is recognized till date. This is called as cumulative catch-up adjustment. So over here, then a cumulative catch-up adjustment is needed, which means you will try to find the revenue recognized till date based on the revised terms minus the revenue which was earlier recognized, and you will pass an entry for the same. So this tries to cover concepts for Ind AS 115, a fairly tricky standard, but I think you have at least a good overview to start studying this standard in a bit of detail. Okay, that should be it then. Thank you very much, and I'll see you with another standard soon. Bye bye, take care.